Below are the financial statements for the Weaver Company during 2009. The company sold some equipment for $20 that cost $40 and had $16 of accumulated depreciation, and sold long-term investments for $10 that cost $3. Cash dividends of $30 were paid during the year. Prepare a cash flow statement using the indirect method. Recall, preparing a cash flow statement using the indirect method requires us to pick up changes in the balance sheet accounts. We're going to begin our problem by considering only the changes as they appear in the balance sheet accounts. And once we have a cash flow statement that balances, we'll incorporate some of the additional information regarding the sale of our equipment, the sale of long-term investments, and our cash dividends. So let's go ahead and begin by considering the first change in our balance sheet accounts. Accounts receivable increased from $240 to $340. This is a $100 change. An increase in assets will show up on our cash flow statement as a use of cash. Next, we have inventory. Inventory decreased during the year from $175 to $125. This $50 decrease in inventory will show up as a $50 source of cash. Prepaid expenses increased by $4 during the year. This is a $4 use of cash, again, in the operating section of our cash flow statement. Next, we have plant and equipment. Plant and equipment increased from $470 to $610. This $140 increase in assets will show up as a use of cash in the investing section of our cash flow statement. Next, we have our change in accumulated depreciation. Recall, accumulated depreciation decreases assets, and accumulated depreciation changed or increased by $8. This $8 in depreciation will show up in our operating section as a source of cash. Finally, we have long-term investments. Long-term investments decreased from 19 to 16. This $3 decrease will be a source of cash in the investing section of our cash flow statement. Moving on to liabilities and stockholders' equity. Recall, increases in liabilities or equity are a source of cash, while decreases are a use of cash. Accounts payable increased from $230 to $310. This will show up in our operating section as an $80 source of cash. Accrued liabilities decreased by $12, which will be a $12 use of cash, again, in the operating section of our cash flow statement. Next, we have bonds payable. Bonds payable is a financing activity, and we had an increase from $180 to $290, so this will show up as a $110 source of cash in the financing section of our cash flow statement. Deferred income taxes relates to operating activities and will show up in our cash flow statement as a $6 source of cash. Our common stock during the year decreased from $250 to $210. This $40 decrease will show up in our financing section as a use of cash. Finally, we have the change in retained earnings. Retained earnings increased by $33 from $74 at the beginning of the year to $107 at the end of the year. We have two changes that can impact retained earnings. Net income will increase retained earnings and be a source of cash, while dividends is a use of cash because it decreases retained earnings. Since we have no other information, we will assume that the increase in retained earnings will equal our net income and list that as a $33 increase or source of cash. Let's go ahead and sum up our changes in cash in each one of our sections. Cash flow provided by operating activities is $61. The cash used in investing activities is $137, and the cash provided by financing activities is $70. When we add together our cash provided by operations of $61 minus the $137 used in investing plus the $70 provided by financing, we get a $6 change in cash, which agrees with the change in our cash flow statement, or our balance sheet rather. Cash decreased from $15 at the beginning of the year to $9 at the end of the year. Next, we're going to go ahead and incorporate some of the additional information provided up above and on an income statement that we'll display here shortly. Here's our income statement for the Weaver Company. We can see that net income is $63, and we're told up above that dividends of $30 were paid during the year. Let's go ahead and incorporate this information into our cash flow statement. Let's begin by including the dividends. Recall that dividends decrease retained earnings, so dividends will be a decrease in cash, and net income increases. So we've got the $63 net income, and once we change that on our cash flow statement no longer balances. But it will when we incorporate the dividends of $30. So once again, if we have increased net income from 33 to 63, we've increased our cash flows by 30. So somewhere else we're going to need to decrease our cash flows by 30. So we make the $63 for net income, and then we have dividends as a use of cash in the financing section. Let's go ahead now and incorporate the information we have regarding the sale of equipment and the sale of long-term investments, and the gain and loss on both of those. Let's begin by observing the journal entry we would have made when we sold our equipment. We sold our long-term investments. We sold our long-term investments for $10 and that they cost $3. Our journal entry would have been a debit to cash of 10 and a credit to long-term investments. We need to take them off the books for 3, and then we would have recorded a $7 gain. So obviously, instead of receiving $3 on the sale of our long-term investments, we actually received 10. So let's go ahead and reflect that on our cash flow statement by increasing the cash from the sale of long-term investments from $3 to $10. Once we do that, we can see our change in cash no longer equals a change from our balance sheet. We've changed one section by an increase in 7. We need to decrease 7 by somewhere else. The gain on the sale of our investments is part of net income. So it's part of the $63 we have up top in net income, but does not represent an operating activity. So we will deduct the gain from our operating section of our cash flow statement. And once again, our cash flow statement will balance. Let's go ahead and take a look at the sale of our equipment. We were told that we sold some equipment for $20 that had cost $40 and had 16 of accumulated depreciation. Here would have been our journal entry. We received $20 in cash. We took $40 of equipment off our balance sheet, and we took the accumulated depreciation off our balance sheet, and we recorded a loss. So let's go ahead and adjust our cash flow statement, because we were told that we received $20 in cash from the sale of plant and equipment. Now again, we can see suddenly our change in cash won't equal the -6 that we had before, so we need to record some other things. The next thing we are told, we had our loss of 4. And recall, the loss would have decreased net income, but it did not involve an operating cash flow. So we will add back the loss on the sale. Still, our change in cash does not balance out. It does not equal the -6 that we had before. What else can we pick up? Let's go ahead and take a look at the T account for plant and equipment. We were told that we had a $470 beginning balance in the plant and equipment. We had a $610 ending balance in plant and equipment. Again, that's from our balance sheet. We credited plant and equipment $40 for the sale, which means the only way we can get our plant and equipment account to balance is if we had purchased $180 in plant and equipment, not the $140 that we currently show on our cash flow statement, but instead $180. So let's go ahead and make that change on our cash flow statement. We have a use of cash. Instead of $140, we have a use of $180. Notice our cash flow statement still is out of balance. It doesn't equal the -6 that we had before we made these changes. So let's go ahead and take a look at the change in accumulated depreciation. Currently, we picked up the change of 85 to 93s, and we said that change had to equal depreciation expense of $8. But let's go ahead and look at the actual accumulated depreciation account during the year. When we recorded the sale of equipment, we credited accumulated depreciation, we debited accumulated depreciation for 16. Therefore, the only way we get our accumulated depreciation account to balance is if depreciation expense, instead of being $8, was actually $24. So let's go ahead and reflect $24 in depreciation on our cash flow statement. Once we make that change, we can see once again our cash flow statement balances. The $6 change in cash equals the $6 decrease in cash shown on our balance sheet from 15 down to 9. So recall, when we have gains, we need to deduct those gains from the operating cash flows. When we have losses, we need to add those losses back.